or wherever you are, and whatever time you're listening to this, good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And the way we do that is by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 195, and in this episode we're reviewing the performance of the financial markets during the second week of 2026, and that is from Monday the 12th to Friday the 16th of January. And without further ado, this is your host Jamuhuri, and together, let's dive right in. We kick it off in the United States, where U.S. consumer prices rose at a lower than expected pace in December, reinforcing the view that inflation was cooling off as the Federal Reserve contemplates its next move on interest rates. According to data from the Bureau of Labor Statistics, the Core Consumer Price Index, which excludes volatile food and energy prices, rose by a seasonally adjusted 2.6% on an annual basis, which was 0.1 percentage points below market expectations. On a headline basis, the Consumer Price Index posted an annual increase of 2.7% in the month of December, which was in line with the consensus estimate. The Federal Reserve considers core inflation as a better gauge of longer-term inflation trends as it removes the noise brought about by volatile food and energy prices. Staying in the United States, on Thursday, the Chicago Federal Reserve President, Austin Goolsbee, expressed caution about the recent attacks on the central bank and its chairman, Jerome Powell, saying that they could adversely affect the outlook for inflation going forward. Goolsbee said that anything that infringes or attacks the independence of the central bank could lead to a mess and cause inflation to start rising again. His comments came just a few days after Powell confirmed on Sunday last week that he had been subpoenaed by the Justice Department with regards to his testimony about the renovation of the Federal Reserve's headquarters in Washington, D.C. And over to China, where export growth in the month of December sharply beat market expectations, catapulting China's annual trade surplus to a new record high, even as exports to the United States declined by 20% due to tariffs. China's exports for the full year 2025 grew by 5.5%, whilst imports stayed flat during the year, increasing China's trade surplus by 20% from 2024 to a new record high of $1.19 trillion. Chinese customs data showed that in US dollar terms, Exports surged by 6.6% in the 12 months to December 2025, whilst imports rose by 5.7% over the same period. In the United Kingdom, data from the Office for National Statistics showed that the UK economy grew at a faster than expected pace of 0.3% in the month of November, compared to economists polled by Reuters who had expected a very modest growth of just 0.1%. The data showed that services and production grew by 0.3% and 1.1% respectively, whilst construction fell by 1.3% in the month of November. Economists project that the UK economy will improve in 2026 as the Bank of England is expected to continue cutting interest rates. On Wall Street this past week, the S&P 500 posted a losing week as traders weighed the latest comments by President Trump with relation to the Federal Reserve and the increased geopolitical risks across the globe. It was a hectic week for investors as they grappled with a stream of headlines coming out from Washington, ranging from threats to the independence of the Federal Reserve to heightened geopolitical tensions in Iran and Greenland. Geopolitical risk was further exacerbated on Friday after President Trump said he would impose tariffs on countries that do not support his proposed takeover of Greenland. For your information, geopolitical risk refers to the potential for an international political event to disrupt global markets. In response, all the three major averages were down for the week, with the S&P 500 posting a decline of 0.4% before closing at 6,940. Meanwhile, the 30-stock Dow Jones Industrial Average dropped by 0.3% to end the session at 49,395. And the tech-heavy Nasdaq Composite was down by 0.7% for the week and eventually settled at 23,515. In the government bond market, U.S. Treasury yields rose on Friday as investors monitored the economic outlook for the country in conjunction with the heightened geopolitical risks across the globe. Investors have been concerned about geopolitical uncertainty as President Trump continued to insist on taking over Greenland, saying it was critical to U.S. national security. Additionally, the president has threatened to impose tariffs on countries that do not support his takeover of Greenland. Meanwhile, tensions between the United States and Iran have eased off after President Trump signaled that he was holding off on military strikes, citing reports that Iran had reduced its violent crackdown on protesters. And in response, the yield on the short-dated 2-year Treasury note advanced by 3 basis points to settle at 3.59%, whilst the yield on the benchmark 10-year Treasury bond gained by more than 6 basis points and closed the week at 4.22%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil rose on Friday as supply risks remained in focus despite the reduced likelihood of a U.S. military strike against Iran. Whilst geopolitical tensions in the Middle East have eased, market players remained concerned about the potential for supply disruptions. Both benchmarks hit multi-month highs during the week after President Trump signaled the potential for military strikes against Iran. However, later in the week, oil prices fell by more than 4% after Iran eased the crackdown against protesters, allaying concerns of possible military action by the United States. Meanwhile, analysts expect higher oil supply in 2026, potentially reducing the geopolitical risk premium on the price of crude oil. The price of the global benchmark Brent crude was on track for a weekly gain of 2% before coming to a close at $64.13 per barrel. Meanwhile, the price of the U.S. benchmark, that is West Texas Intermediate crude, recorded a weekly gain of 1.4% before settling at $59.44 per barrel. In the precious metals market, the price of gold fell more than 1% on Friday as investors booked profits after recent record highs, whilst signs of easing geopolitical tensions further reduced its appeal as a safe haven asset. Geopolitical tensions appeared to ease as the crackdown on protesters in Iran subsided and as President Trump signaled that he was holding back on military strikes against Iran. Meanwhile, data compiled by LSEG shows that the Federal Reserve is expected to keep rates unchanged through the first half of this year, with the first rate cut projected in June 2026. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. The price of spot gold was on track for its second consecutive weekly gain of about 1.9% before eventually settling at $4,606 per ounce. Meanwhile, the price of spot silver was headed for a weekly gain of over 12% as it came to a close at $89 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.03, and this is compared to 128.99 the previous week. Meanwhile, the sterling pound was priced at 173.52, and the euro was valued at 150.33. And on the regional front, one Kenya shilling was changing hands for 27.59 Ugandan shillings and 19.45 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The IMF has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $93 million for a grand total of $12.47 billion, which is equivalent to 5.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. But despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances to Kenya totaled to $435 million in December 2025 compared to $445 million in December 2024, which was a decrease of 2.2%. However, for the 12 months to December 2025, the total remittances received totaled to $5.03 billion compared to $4.94 billion in 2024, which was an increase of 1.9%. The inflow of remittances remains a major source of foreign exchange earnings for the country and continues to support the balance of payments as well as the domestic foreign exchange market. The United States remains the largest source of remittances to Kenya, contributing slightly more than 50% of the total remittances that were received in 2025. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 9%, up slightly from 8.97% the previous week, and perfectly in sync with the central bank rate, which is also at 9%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 26.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 15th of January, and the central bank received bids totaling to 30.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 128%. The central bank ended up accepting 28.5 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2 basis points to settle at 7.70%, whilst the 182-day rate was stable at 7.80%, and the 364-day rate remained unchanged at 9.20%. At the Nairobi Securities Exchange, in 2025, the Kenyan equity market was on an upward trajectory, with the NSE 20 gaining the most by 52.5%, whilst the NASI, the NSE 10, and the NSE 25 gained by 48.9%, 48%, and 47.4% respectively. The market's performance was driven by gains recorded by large-cap stocks such as DTB Bank, which increased by a staggering 71.5%, whilst both Safaricom and NCBA Bank rose by about 65%, and the other top performers included the likes of Kenya Commercial Bank and East African Breweries, which increased by 55% and 50% respectively. It was quite surprising that in a bull market, foreign investors remained net sellers with a net outflow of about $93 million. In 2025, 8 companies issued profit warnings as compared to 15 companies in 2023. The decrease in profit warnings in 2025 highlights the improving macroeconomic environment that was occasioned by the stability of the Kenyan shilling, coupled with the easing of monetary policy as inflation remained low and stable. Up next is our topical issue, and this week we are looking at concerns raised by professional associations on the government's plan to sell a 15% stake in Safaricom. The Kenyan government is currently facing intense scrutiny over its proposal to divest a 15% stake in Safaricom to South Africa's Vodacom Group for approximately 204 billion shillings. While market regulators like the Capital Markets Authority and the Nairobi Securities Exchange have endorsed the transaction, the plan faces scrutiny from accountants and the banking sector. The Institute of Certified Public Accountants of Kenya have raised several objections, primarily focusing on the valuation methodology. They argue that the proposed price of 34 shillings per share lacks public justification and sits significantly lower than the company's 2021 peak of 44 shillings and 70 cents. Furthermore, analysts mentioned in the sources warn that basing the price on a premium of historical trading data rather than the intrinsic value could result in the deal being undervalued. Beyond financial concerns, the sources highlighted a potential loss of strategic control. If the deal proceeds, Vodacom's shareholding would increase to 55%, potentially limiting the government's influence over Safaricom's strategic direction and policy-sensitive decisions. ISPAC also expressed concern regarding the loss of predictable dividend income and suggested that an initial public offering would be preferable to direct negotiations with Vodacom. In addition to the above objections, the Kenya Bankers Association has also lobbied Parliament to amend the terms and conditions of the sale transaction. The bankers propose that about 300 million shares should be sold directly to the public in order to deepen the capital markets and to broaden the ownership structure, with the remaining 5.7 billion shares going to Vodacom. Currently, only 25% of Safaricom's shares are available for public trading, and the bankers believe that the proposed amendment will help to increase market liquidity. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhurigi@gmail.com, Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the elevator to success is out of order, so you'll have to use the stairs one step at a time. A quote by Joe Girard. Think about it. Thank you, and God bless.